everyone, welcome to our Accounting 312. In this video, I want to talk about the textbook example for the cost analysis regarding the tax effect, okay? So we focus on the relevant cash flow, and then we try to figure out how tax will affect your relevant cash flow. So all the numbers they are from your textbook. I just summarized all the information and put it here. Your final exam, will also be related with this type of question. Different numbers, and then the format will be kind of also maybe different. I use this table. Our final exam, you may just have listed at least all the information. But logic is definitely the same. So let's look at this one. I don't want to repeat the question, but you're buying a new bus and then tax rate 40% or 8%. Before tax cash inflow, because of the bus is the first 4 years is 220,000 and the last year is 170,000. You use straight line depreciation, no residual, right? And then you have old bus, you have a new bus. As I mentioned, this chapter is built on chapter 11, so we only focus on relevant cash flow. So what's the relevant information? Annual depreciation expense, old one is 12,000, the new one is 132,000. So you have a relevant depreciation expense, 120,000. Working capital, old one 6,000, the new one 36,000. You have relevant working capital 30,000. So now let's look at the first. What's the net initial investment? What's the net initial investment? I hope you feel more comfortable when you hear net initial investment. There are 3 items in this big umbrella. I suggest the students to first list the 3 item name. I promise you, as long as you list the name, you will get at least 1 point, okay? How about this deal? You list this name, you get at least 1 point. You get at least 1 point. So the 3 items, the first one is the cost of the new bus. No doubt, I don't worry my students, you are so smart, you know the cost of a new bus. You can see it from your here, the information is 660,000. It's outflow, so I put negative there, 660,000 outflow. The only thing I want to point out is in textbook, it's straightforward, just said purchase price. But the cost of the equipment is not just the purchase price. If you have any installation fee, transportation fee, legal fee, title fee, that's also part of the cost of the equipment. All the costs happened before the equipment is ready to be used, right? Cost of the new bus, and then we said extra working capital, 30,000 outflow. Because with the new bus, you have to buy, extra inventory, you have more account receivable, account payable, those things. So it's related working capital, current liability, and current assets. I don't worry about my students. The only thing I want to point out is cash inflow of selling your old bus, okay? In chapter 11, we said, hey, gain or loss doesn't matter. We just look at the selling price. But here, gain or loss will play a big role because of the tax effect. Why? Think about this. Gain will increase your operating income, right? If you have more income, you have to pay more tax. So the cash left for you will be less. If you have a loss, that will decrease your income. So you pay less tax. So you have a tax saving, you save your cash. How do we do an adjustment? We always start from the selling price. We always start with the selling price. As I say, if it's a gain, then you have to pay more tax. So we have to subtract the gain times the tax. We don't pay all of the gain. We pay just the extra tax because of the gain. Or we have a tax saving from the loss. So if it's a loss, we add more cash inflow, right? We don't save all of the loss. We just save the tax part. Let's look at this question. Disposal value of the old one is 28,500. We assume you dispose it by selling it. You know, you don't dump it in the trash. You sell it as disposal when you dispose it. So our selling price is 28,500. Current book value is 60,000. Okay, how do you get the book value? Book value is your cost minus your cumulative depreciation. How do you get the cumulative depreciation? It's just depreciation expense times the years, right? This question told you the current book value, but some multiple choice in the assignment, they don't tell you. So you have to make sure you have to calculate the current book value. But this one already told you book value is 60,000, but you only sold at 28,500. You have a gain or loss. Tell me. You have a loss, right? You have a loss. How do you decide if you have a gain or loss? We compare selling price with the net book value, right? So selling price is more than book value is a gain. Selling price is less than the book value is a loss. This one very obvious. You have a loss. How much? 31,500. 31,500. So we have a loss. Because of the loss, we will pay less tax. So we have a tax saving from this loss. That's the reason we have to add the tax saving because of this loss. So we do other adjustment. Selling price 28,500. We have a loss. We add the tax saving from the loss. Loss is 31,500. Do we save all of this 31,500? No, we just save the tax part. So we just save 40%. So that will be 28,500 plus 12,600. We get our after-tax cash inflow of selling the old bus is 41,100. 41,100 is the cash flow, relevant cash inflow of selling the old bus after taking care of the tax effect. So your net initial investment will be outflow 660,000, outflow 30,000, inflow 41,100. Your net initial investment, when t equals to 0, net initial investment will be outflow 648,900. This is t equals to 0. You have this outflow as net initial investment. So when t equals to 0, you have a net initial investment. And then we said t equals to 1, 2, 3, 4, 5, right? We have 1, 2, 3, 4, 5. That initial investment is t equals to 0. Okay, next part. What's the annual cash flow from operation? This part is straightforward. Basically, you just have two items. The first item is after-tax cash flow from operation. After-tax from operation. The next one, we call it a tax saving from depreciation expense. Tax saving from depreciation expense. Pay attention to the word, right? This is after tax. This is after tax. After tax. Listen to me. This is the only time you will see this word after tax. All the others, we call it a tax saving, tax payment. This is the only time you call it after tax cash flow from operation. We do this for every year from T1 all the way to T5. So you have this cash inflow for 1 year, 2 year, 3 year, 4 year, 5 year, okay? After tax cash flow from operation, question told you very clearly, before tax, the first 4 years, every year is 220,000. And the 5th year is 170,000. So this is year 1 to year 4, 220,000. Year 5 is 170 before tax. So what's the after tax? After tax is 1 minus tax, okay? It's 1 minus tax. All the others are just tax. This is the only time you have 1 minus tax after tax. So you have 132,000 from t equals 1 to t equals 4. And then you have 102,000 for the 5th year. This is after tax cash flow from operation. After tax cash flow from operation. So you have this 132,000, 132,000, 132,000, 132,000, 102,000. Are we done? Nope. We still have the next part called tax saving. It's not after tax saving, it's a tax saving from depreciation expense. Why we have this? Because of the new boss, every year we have an extra depreciation expense 120,000, right? Every year we have extra 120,000. You have extra expense that will decrease your income, so you pay less tax. You have a tax saving from the depreciation expense. So our depreciation expense is 120,000. Do we save all of 120,000? We just save the tax part, 40%. So our tax saving for every year is 48,000 from first year all the way to the 5th year. So you have 48,000, 48,000, 48,000, 48,000, 48,000 from t equals to 1 all the way to t equals to 5. So if I ask you, hey, what's the annual cash flow from operation? Your answer should be when t equals to 1 to t equals to 4, it is 132,000 plus 48,000 gives me 180,000. T equals to 5 is 102,000 plus 48,000 gives me 150,000. Does this make sense? Okay. Finally, after 5 years, we get rid of this new boss, so we have the terminal disposal of investment. You only do this when t equals to 5. So you only do this at the end of the project. You only do this at the end of the project. And then at the end of the project, it's very similar as at the beginning of the project. Why I say that? Because at the end of the project, you get your working capital back as the cash inflow, right? We said, remember when we talk about working capital at the end of the project, you liquidate your inventory, you get your working capital back, 30,000 as cash inflow. Now you also sell your new boss now, right? You bought it 5 years ago, now you sell the new boss. Then you have to do all the other adjustment one more time for the new boss. You have to do all the other adjustment. You sell the new one, selling price may be different from the book value, so you have to compare again or else do the adjustment one more time, exactly as here. But for this question, it's easier because at the end of the project, disposal value is 0. and then we don't have any book value, so it is 0. Just 0 and just 0, it's 0. So in this case, our last year, the 5th year, we have two extra cash inflows. We get 30,000. We get 30,000 from liquidating our working capital. We also have 10,000. We also have 0,000. We also have $0 for the selling of new bonds. So your total terminal disposal value will be 30,000 cash inflow. So I'll summarize it one more time. At the beginning of the project, it's called net initial investment. You have 3 parts: cost of new bonds, actual working capital, and then you sell your old bonds as cash inflow. You have to do an adjustment for tax effect. Then from the 1st year all the way to the 5th year, every year you have 2 sets of cash inflow. After tax cash from operation, and then tax saving from depreciation expense. At the end of the project, you have 2 items. You got your working capital back, you sell your new bonds. So eventually, the 5th year, you have 4 items. After tax cash flow, tax saving from depreciation expense, get your working capital back, and then selling your new bonds. So overall, this is the clean cash flow from this project. I'm not going to talk about NPV, IRR. You can see this from your textbook. Let me know if you have any question. Thank you.